Unlike what the majority of people say, becoming wealthy is not difficult. Most people just don't want to get rich slowly. I'll show you what I mean. See, when most people think about what does it take to become wealthy, they assume that the first thing you need is a big salary. But that's not the case. The average person is working for money. Wealthy people are working for more assets. But here's the catch. In order to own more assets, you need to get more money. But the reason why so many people don't become wealthy is because they're working for more money to buy a faster car, to buy a bigger home, to buy a nicer vacation. But what wealthy people are doing, which is different, is they're working for more money to buy more assets. And in order for you to become wealthy now sooner rather than later, if you want to become wealthy by 40, what you have to understand is TRD. Time, return, dollars. If you can understand how TRD compounds your wealth, you have all the tools that you need to become financially free. Starting with time, it takes time to compound your wealth. Amazon did not become a $1 trillion company overnight. They were founded back in 1994 and then they became a $1 trillion company in 2018. That means it took 24 years. So now when you're going out and investing your money, these assets that you're investing in, whether it's real estate, whether it's companies, whether it's stocks, they need time to grow and they need time to compound. The more time that your money has to grow, the wealthier that you will become. But this is the only factor in TRD that you cannot control. You can't go back in time and start investing 5 years ago, although we would all love to do that. You can only start investing today. Out of the TRD, time is the only factor that you cannot influence, minus starting to invest sooner rather than later. Next is R, return. This is the velocity of your money. How fast can you double your money? If you have $1,000 today, how fast can you turn this $1,000 into $2,000? Then your $2,000 into $4,000, into $8,000, into $16,000, into $32,000, into $64,000, into $128,000, into $256,000, and now we're starting to talk. Because as that money starts to grow, now, even if you grow by the same rate, we're talking bigger numbers. Because in the beginning, you're talking about 1,000 to 2,000 to 4. But when you get into the bigger numbers, now you're talking about 64,000 to 128,000 to $256,000. And that's where that time plus the return can start to compound one another, because if you can double your money quicker, if you have the faster velocity of money, if you know how to grow your money faster, well, now you can really compound your wealth. And that's one of the things that we're going to be talking about. If you stick with me through this video, you're going to know the different ways that you can grow your money faster so you can get a better return, because most people have no idea about how they can get faster returns, let alone really influence their returns at all. Then you have D, dollars. The amount of money that you invest. The more money you invest, the wealthier that you can become. Going back to the Amazon example, if Amazon 10x'd, if you invested your money to Amazon and you were able to 10x your money, well, the amount of money you make depends on how much money you invest. If you invested $1,000 into Amazon, well, that's going to grow to $10,000 if you can 10x it. If you invested $10,000, that means you could grow it to $100,000. So the question is, how can you invest more money? And there are strategic ways for you to have more dollars to invest. That way now you can compound the T, the R, and the D. That way you can really compound your wealth, because it's not just one factor. Most people assume that the way you become wealthy is just by making more money. But the key is not to make more money. The key is to own more assets. How can you own more assets? You need more money. But then once you own the assets, you also need to know how can you get the best returns. Now, when you're getting the best returns, it's also how long can you compound those returns. That's why you have to understand the T, the R, and the D if you really want to become wealthy, and this is what wealthy people understand. Now, it's just math. If I invest $1,000 a month and I can get a 5% return, in 10 years, that's going to go to $158,000. But if I can invest $2,000 a month, the dollars, with a 10% return, the return, for 20 years, the time, now I'm going to have $1.5 million. Since you can't go back in time to influence the amount of time that you have, let me start by talking about the R, the return, because there's 3 general categories of returns, from low returns to higher returns. On the low end, you have the paper investments. This is like investing your money in cash, in savings, in CDs, or even bonds. On the low end of returns, you have what I call the cash investments. This would be like saving your money into a savings account, or putting your money into a bank CD, or by putting your money into bonds. You don't actually own an asset, but you're getting some interest on the cash that you have. The second way that you can get higher returns is by investing your money into what I call passive assets. This would be like investing your money into stocks or investing your money into real estate. And the third way that you can invest your money to get potentially even higher returns is by investing your money into what I call active assets. So starting with the cash assets, investing your money into stocks, investing your money into CDs, investing your money into bonds. These are not ways for you to get rich. These are places for you to park your money temporarily. It's a place for you to keep your money and get a little bit of return, hopefully some interest, because now you have some high interest savings accounts that are actually paying 3, 4, close to 5% in interest that are FDIC insured. Some CDs are paying 5% in interest. Some bonds are paying close to 4 to 5% in interest. So yeah, you can finally get some return on that cash, but you don't actually own an asset. And the reason why that matters is because you can get some cash flow from the return that you're getting, but the value of your asset is not growing because you just own the cash. And in fact, the value of your cash is actually declining because when you have inflation, the buying power of your asset, the cash, is going down. So when you own this cash investment, you're really not becoming wealthier besides the fact that you might be getting a little bit of interest. That's not how you get rich, but it's a way that you can park your money. It's a place where you can put some money and get a little bit of return while you're waiting for a good place to put your money. So now if you want to get better returns, now you got to look at either passively investing your money or actively investing your money. When we talk about passive assets, stocks or real estate, you now have the ability to decide and control how involved you want to be. And this is going to get a little bit confusing, but you can be a passive investor in passive assets, or you can be an active investor in passive assets. And what I mean by that is you can influence the type of returns that you get in the stock market or in the real estate market or by investing in other companies by influencing how involved that you are. Naturally, the more involved you are, the higher potential returns that you can get. Is it guaranteed? No, of course not. But it is a potential to get better returns because now you're actively researching your investments. You're looking for the better investments. You're trying to find the better price versus just being passive and letting it happen automatically. Now, what does this mean? The stock market is a place where you can put your money and invest into businesses. You can invest into the United States economy. You can invest into companies that make America America. When you invest in real estate, you're buying physical properties. You're not buying it to live in yourself. You're buying it to rent out to other people. And so now the question is, how involved do you want to be? Some of you watching this are money nerds like me, and you're going to say, you know what, I love reading financial spreadsheets. I love studying companies. I like listening to earnings calls. I like doing all that stuff. But many of you are going to say, that sounds like a lot of work. I don't have time to do that. I'm a busy professional. That sounds like a lot of risk. That sounds like a lot of things that I don't understand. And if you don't want to do that, that's okay. You can just be a passive investor. Now, instead of trying to find the best company to invest in, you can just put your money into the economy. You can just put your money into the stock market. And that means now there are funds out there, index funds, ETFs, mutual funds, that you can just put your money into that will give you exposure to the stock market. There are index funds and ETFs that will give you exposure to the total stock market. There are index funds and ETFs that will give you exposure to the S&P 500, the biggest 500 companies in the stock market. There are index funds and ETFs that will give you exposure to the biggest tech companies. There are index funds and ETFs that will give you exposure to the biggest dividend-paying companies. So now the question is, do you want to find the individual companies, keep up with that company, find the best buying point, keep up with the earnings calls, study the financials, and then make the decision on when to buy and when to sell? Or do you want to just create a passive system where now every week or every 2 weeks, every time you get paid, money just automatically gets invested into the market? What I do is both. I have a passive and an active investing method. For me on Wednesdays, and there's no special sauce as to why it's Wednesdays, it's just picked Wednesdays. On Wednesdays, money is automatically pulled out of my checkings account and is automatically invested into the markets. I don't have to do anything. That's why I like it, because I have a horrible memory. I will forget if I had to do it myself. Every Wednesday, money gets pulled out and it's invested into my portfolio of ETFs, these funds. Now, I have funds that give me exposure to dividends. That's cash flow. I have funds that give me exposure to the S&P 500, the biggest 500 companies in the stock market. I have funds that give me exposure to innovation, technology. I have funds that give me exposure to emerging markets, countries and companies overseas. Every Wednesday, whether the market's up or down or sideways, doesn't matter what's going on in the markets, money is pulled and automatically invested. That's passive. I don't keep up with what's going on here because It's automatic, it's passive, and it's consistent. I don't have to touch it. And the only time I would change it is if markets go down, maybe I'll buy more. This is a long-term investing gain. This is a long-term plan where now the plan is to just work to accumulate these assets and get some cash flow from it. On the flip side, I also have an active investing method, and I should also recommend or say that I don't recommend what I do to anybody. Make sure you do your own research and never, ever, ever blindly trust a random guy on YouTube. Anyways, I have an active investing strategy, which is where now I look for individual companies to invest in because that's something I enjoy doing. And when I find a good company that I like, where I see the price has fallen, then I'll come in and buy. Now, this is more risky because, well, I could be buying a company right before they go into bankruptcy. Or I could be buying a very bad company. Or I could be buying a company on the verge of a downturn. Or I could be buying a company right before an economic crash. There's more risk involved, but this is where you have to decide what type of investor do you want to be. Same with real estate. I invest in real estate. But for me, I also enjoy that. I'm an active investor in real estate. I'm looking for real estate deals, homes or apartment complexes where I could see opportunity to come in, buy it at a discounted price, fix it up, rehab it, increase the value, get it now for below market value because I bought it at a discount, and then rent it out. That way I can generate some cash flow. There's a lot of different ways that you can invest. If you say, oh, but Jaspreet, I would love to be invested in real estate. I just don't have all the money or I don't want to spend all the time. There's passive ways for you to get involved in real estate. I just talked about the active method. There's passive ways. You could go and become a real estate syndicate. You can invest in syndicate deals. There's always investors and developers that are looking for money. Go to any real estate conference in your area. You're going to find an investor or a developer that's trying to buy some apartment complex or some building, or they're trying to redevelop some building, or they're trying to build some building, and they need money to help fund that. Well, if you have some money, but you don't want to put in the time, you can invest into the deal, and then if the deal makes money, you would get your return. If the deal loses money, well, you would lose your money. There's also platforms on the internet that allow you to do the same thing. And so this is where now understanding, do you want to be more of a passive investor or an active investor into these types of passive assets? Now, when it comes to the type of return that you can get, when you invest in these types of passive assets, if you go in thinking you're going to get 50, 60, 70% returns, you're going to get lured into the get rich quick crap on the internet because somebody's going to sell you this crazy program on how you can get these insane returns in the markets when in reality, the average returns have been somewhere between 7 to 10% a year. Does that mean that they always go up? No. Sometimes they go down. Sometimes they go up more, but that's the average. So you got to understand now what types of returns that you want. If you want to get higher returns, it is possible, but you're going to have to get more involved, but you're also going to have to understand the risk. You got to decide, are you going to be passively or actively investing your money into these passive assets? But the key is now your money is also working to grow. However, there's a risk. There's a risk you could see a market crash. There's a risk you could see a recession. There's a risk that the assets that you invest in go down. However, you also have the potential for more reward. And generally what we see happen is if you invest in good assets and you see a market crash, if you hold on to it, well, then you'll be able to make your money back. But this is where you have to also understand how do you control your emotion, which is a whole different part of investing, the psychology of investing, which is one of the reasons why so many people end up losing money. It's not because they pick bad investments, it's because they don't know how to manage their investments. But that's a topic for a different video. See, when you invest actively into a stock, you have to spend the time to find a good investment, but you're not actually operating the investment. Here, when you find a good investment, you have to spend the time to do that, but then you also have to spend the time to operate the investment. That's what can allow you to get even higher returns. But it also comes with the most risk. I invest in startups, but startup investing is risky. The statistics say that something like 9 out of 10 startups will fail. So that means 9 out of 10 of the companies statistically that I invest in will fail. The goal is that the 1 out of 10 company will make up for all the losses, but there's no guarantees that you're ever going to find that 1 out of 10. And when you go out and you invest in a business, maybe you want to go out and invest in a franchise. You want to go out and buy a laundromat or a convenience store. Well, now you can take that $10,000, use it as a potential down payment to buy the asset. You're buying the business. And now you're going to have to also work to grow the value of the company, to grow the profit of the company, because now you're buying the asset. Or you could take the $10,000 and use it to fund your own business idea. There's an unlimited number of options of things that you can do here. If you have a business idea, you can use this money as seed capital to help you get started. I have a company called Briefs Media. That is my full-time job. I am the CEO in that company. And now what I do is when I have extra money, when we make a profit, I can invest this money back into the company. What can you do with it? Well, we can invest this money into advertising to get more customers. I can invest this money into newer softwares. I can invest this money to hire more employees. I can invest this money into a new office. We can invest this money in a lot of different places with the goal of trying to grow the money. And now there's really no limit to what types of returns that I can get. But the question is, how are you going to do that? And how effectively can you scale it? And that's not always easy, because the risk is that you do something wrong or that the business doesn't work. Because I can invest tons of money into the company, but if the company doesn't work, the employees lose their jobs and I lose my job, plus I lose all the money that I invested into the company. So there's a risk involved with it. And this is where you have to understand, number one, are you willing to entrust and believe in yourself? And number two, do you have an idea that's worth investing in? So now back to the original question. If your goal is to become wealthier sooner rather than later, you have to understand TRD. We talked about the time. You can't control that. You can impact the return by changing how you invest your money. You can invest your money into cash and get a little bit of interest on your money, but that's not going to make you rich. You can invest your money into passive assets and get somewhere between 7 to 10% a year. You can invest a little bit more actively in these passive assets to hopefully get a little bit higher returns, but those are generally the returns. Or you can invest your money into more of active assets, things like startups or businesses or your own business idea, where now you are working to also grow the value of your money. And now there's really no limit to what types of returns that you can get. But once you understand the T and the R, the last question is the D. And by the way, if you haven't gone out and played with a compound interest calculator, there's a ton of them on the internet. Just go to Google, search compound interest calculator and play around with it. That way you can see for yourself what types of returns you need, how much money you invest based off of how much time you had to hit the retirement and financial goals that you want to be financially free. But now going back to D, dollars. How can you now amplify your returns by having more dollars to invest? And this one ultimately comes down to either A, spending less money, and or B, earning more money. That's really where it comes down to. So now, if you want to invest for money, the first and most accessible thing, not the funnest thing, but the most accessible thing is you can spend less money. If you make $50,000 a year and you spend all $50,000, you have no money to invest. If you make $50,000 and you spend $40,000, you have $10,000 to invest. If you make $50,000 but you only spend $30,000, you have $20,000 to invest. Is it easy to live off of $30,000? No. Is it possible? Sure. But this is where now you can also work to earn more money. Now, if you're living off of $45,000 a year and you make $50,000, you can invest $5,000. But if you make $100,000 a year and you're living off of $45,000, now you can invest $55,000. So the question now is, what do you do to earn more money and what do you do to spend less money? I always recommend starting by spending less money because it is the most accessible thing, and you have to know how to live below your means before you start earning more money. Because otherwise what happens is you start earning more money and you don't know how to control your spending, and now because you earn more money, you become more credit worthy. Because banks see that your income went from 50 grand to 100 grand. Now all of a sudden, you got the bigger credit cards with bigger lines of credit. You got bigger home equity lines of credit. You got bigger lines of debt that banks are willing to extend to you. And if you don't know how to control your spending, now all of a sudden, you're going to drive a much faster car. You're going to end up in a bigger home. You're going to end up going to fancier vacations. And all of a sudden, you thought you'd have more money to invest, but you're really just in a worse financial situation now than you were before, because now you have bigger liabilities, more expenses, and higher payments. And that's why you have to learn how to spend less money first. Once you know how to spend less money, the question is, how do you earn more money? Now, you can work to earn more money by investing more money into active assets. If you have a business idea that you're running, well, now you can pay yourself a salary out of this asset. And if you can grow the amount of money that this business is making, you can have more income for you that you can use to invest more. Or you can work to invest some of this money into your own education, to learn how to sell, to learn how to get a career change, to learn how to get a certificate. That way you can supplement your income. Either you work to get a new job, you work to get a second job, or you work to get a career change where now you have the ability to earn more money. Because remember, it goes back to the TRD. You can't influence the time. You can influence the return by changing where and how you invest your money. And then you can influence the dollars, how much money you invest. You have the control to change how much money you earn. If you want to earn more money, you got to be willing to put in the sacrifice. How do you do that? Start by canceling the Netflix. The average American is spending almost 3 hours a day, 2.9 hours a day watching Netflix. If you reallocate that Netflix time to learning time, and now you're learning how to build a business, you're learning how to make money on the internet, you're learning how to build stores on the internet, you're learning how to build SEO presences on the internet, you're learning how to build content on the internet, well, pretty soon, if you devote the time to it, you're going to be able to make your first dollar on the internet. And if you can make $1 on the internet, you can make $10 on the internet. And the interesting thing about making your first $10 on the internet is once you do that, you're going to realize how you can make your first 100. And when you make your first 100, well, then you're going to see the path to making your first 1,000. When you make your first 1,000, then you're going to see the ability to make the first 10,000. And when you make your first 10,000, that's when it starts to get interesting, because then you're going to see the real route to make your first 100,000. And then all of a sudden, you're going to see the ability to make your first million. But in order to make your first million, you need to know how to make your first dollar. And that's the hardest part, getting that first dollar, because getting that first dollar means you have to get everything set up. You have to figure out how to find a product. You have to figure out how to get customers. You have to figure out how to manage customers. You have to figure out how to manage the back end. You have to figure out how to manage the product. All these things take time. They take skill. They take nurturing. But if you're willing to go through that work, well, then you have the ability to make really whatever amounts of money that you want. And you can decide once you get to that 50,000 or 100,000, do you want to keep your foot on the pedal, to keep revving up the gas, to keep trying to grow that income? Or do you say, you know what, I got a pretty decent stream of income here, and I don't want to keep risking my lifestyle. How about I just chill now that I'm making this income that I'm happy with? And that's your decision to make once you start making that money. Some of you are going to say, you know what, if I could just make an additional $1,000 a month, I'm good. That's all I need. That's going to allow me to make my car payment, make my mortgage payment, and I'm going to be a lot more comfortable. And now I have an additional $1,000 a month to invest, which is going to tap onto my portfolio. And now I'm going to have the financial freedom that I wanted in time when I wanted, and I'm okay. Others of you are going to say, screw that. I need more money. I want to have more wealth. I want to fly in the private jets. I want to have the Rolls Royce. I need to have more of that money in order to fund that dream lifestyle. And you're going to keep your pedal to the metal. But it's up to you. But the key is just getting started. So now, if you want to become wealthy sooner than later, it's TRD. How much time do you have for your money to compound? What returns can you get? How fast can you double your money? Where are you putting your money to actually grow your money? You want to get the fastest returns? Put it back into your business. If you just want casual returns, put it into passive assets. If you don't want to see any returns, you just want the cash to sit there and get some interest, put it in cash. It's a place to park that money. Then, if you want to get more wealthy, you got to put in more dollars. How do you get more dollars? You can spend less money. Everybody should be able to start there. Then you can also work to earn more money. That's in your control. But in order to be able to earn more money, you have to also be able to invest in your own education. That way you can learn from people on how you can earn more money. And once you understand that formula, then it's just a matter of doing it. The natural next question that everybody has here then is, but what about what's going on in the economy? Should you be investing your money now when you have all these worries about the economy? Or is the economy and the stock market too high for me to be investing my money? Are asset prices too overvalued? Where is the economy going? And this is where you want to be paying attention to what's happening. That way you can make the best decisions with your money. By the way, if you do want to stay up to date on what is happening in the top finance and business news, you can join something like Market Briefs. Market Briefs is my free financial newsletter that I created to help investors like you stay up to date on what's happening in things like the housing market, the stock market, the crypto market, the global economy, and our own economy into a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning, and it's completely free. So if you have not joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market. And I'll also link it for you down in the description below. The question on every investor's mind right now is, where is the recession? The stock market is booming, the real estate market is growing, and companies still can't find enough workers. And naturally, this boom that we've been seeing has caused people to start partying and celebrating the end of a potential recession. We've been seeing consumer sentiment rally, and everyone's saying that the chances of a recession are gone. And all of this sentiment put together is part of the reason why Wells Fargo recently put out an economic report where they said essentially, whoa, hold on there, cowboy. We at Wells Fargo still believe that there's a recession coming ahead. And interestingly, this economic report was published right around the time that they released their earnings, where they said that their profits are booming. And Wells Fargo didn't hold back in their economic report. Let me actually read you their first line from this report. It said, better than expected, talking about the recent boom in asset prices and the economy does not mean all is well. To get right to the point, what Wells Fargo says is that, in our view, the best news for 2023 global growth is likely in the past. There are 5 main points that Wells Fargo talked about in their economic report. Number 1 is that the economy is still chugging along, but it's losing steam. Number 2 is that the labor market is still too tight. Number 3 is that inflation is still too high. Number 4 is that fiscal policy or government spending is going to be a concern. And number 5 is the international developments and the United States dollar. So let me start by talking about number 1, which is the economy is still chugging along, but it's losing steam. Essentially, what Wells Fargo is saying about the economy is that, well, it's been resilient. In fact, it's been more resilient than really anybody, including them, thought. But this does not mean that we're not going to see any sort of economic slowdown. And in fact, we're starting to see the impacts of an economic slowdown now. What they said is that the economy has continued to weather the headwinds stemming from the tighter monetary policy and the fading of fiscal support better than generally expected. That means although we've been seeing the higher interest rates, that means although we've been seeing the government cut back on stimulus, that means although the Federal Reserve Bank has been doing quantitative tightening, we haven't seen a drastic slowdown at all in the economy, which was unexpected. However, what they're saying is that the excess money from the pandemic and all the stimulus is starting to fade away. And when that happens, plus when student loans restart, which is really the last kind of incentive program from the pandemic, that's when they expect to see more changes in the economy later on in 2023. Here's what they said. Only about 1/4 of excess savings remain, and it's being tapped at an even slower rate, while the availability of and demand for consumer credit is declining amid the higher interest rate environment. Later this year, student loan payments are going to restart, which is going to be a headwind for households with student debt. Remember, our economy runs on spending. The more money you spend, the richer somebody else gets. And what Wells Fargo is saying is that the spending ability is going down. Why? Because this excess cash is going down, and people's ability to spend on debt, because we live in a credit-based economy where people can spend not just based off of how much cash they have, but based off of how much debt they can qualify for, credit is tightening up. Why is it tightening up? Number 1, banks are being more strict, but number 2, interest rates are also higher. So people are less willing to go into debt to spend, and people have less spending ability because they have less cash left over to spend. Then to top it all off, we have the student loan payments that are restarting towards the end of 2023. And this is where Wells Fargo is saying once all these things really start to play out in the coming 6 months, that's when we'll start to see more headwinds in the economy. They said we expect the ongoing squeeze on credit and profits to lead to a contraction in business fixed investment as the year progresses. In other words, if people start spending less money, that means businesses are going to make less money, and if they start making less money, they're going to stop investing money back into their businesses, which would lead to that economic slowdown that they're talking about. This brings us to the second point that Wells Fargo talked about, which is that the labor market is still too tight. At some point over the last 24 months, you've probably heard the Federal Reserve Bank or the government or some economist saying that the labor market is too tight. What that means is that employers are still having a tough time finding employees. This chart from the Bureau of Labor Statistics helps to explain that. And what you see is that right now in 2023, we're still seeing this economy where there are more job openings available than people that want a job. This is unlike anything we've seen in recent history. This is creating that tight job market, which is also contributing to inflation, but this is creating that tight job market, which the Federal Reserve Bank is working to change. They want to raise interest rates to loosen and soften the job market, which means essentially they want to get rid of some of the jobs out there, aka increase unemployment. That's the unpolitically correct way to say it. But when you hear somebody say loosen the job market, that means higher unemployment. Wells Fargo says that we expect job growth to turn negative in the spring of 2024 and for the unemployment rate to peak around 4.6% in the second half of next year. Now, for full transparency, currently we're at about 3.5% unemployment, which is some of the lowest unemployment we have seen in decades. 4.6% unemployment, which is what Wells Fargo is predicting for the second half of 2024, is still historically pretty low, but that would require that a couple million Americans would have to lose their jobs between now and next year in order for us to hit that unemployment number. But the reason why they're expecting unemployment levels to go up goes to inflation and the fight on inflation. The weight of this evidence still suggests that the labor market remains too tight to be consistent with 2% inflation, and we expect more softening in the labor market in the months ahead. There you go. What Wells Fargo is saying is that the job market is too tight to have this 2% inflation. The Federal Reserve Bank wants to bring inflation down to 2%. But in order to bring inflation down to 2%, what Wells Fargo is saying, you can't have a labor market with such low unemployment. The reason why is because now when you have such a tight labor market, companies have to compete against each other to get an employee. Now, for a company to compete against one another to get an employee, what do? They're going to offer you more benefits and a higher salary. Now, that might sound like a good thing, which it is if you're an employee, but that can also contribute to higher inflation because if you make more money, what do? You spend more money. If you spend more money, that's higher demand. Higher demand means, well, more people buying things, which can push the prices of products up. This is where now Wells Fargo is looking at what the Federal Reserve Bank is saying, which is the Fed wants to soften the labor market, right? That's the politically correct way to say they want to increase unemployment. The Federal Reserve Bank wants to soften the labor market, which means more unemployment ahead. This brings me to the third point that Wells Fargo made, which is regarding the inflation numbers that we're still seeing. As expected, recent data shows a downward trend in inflation, which is clearly underway, but a sustained return to 2% inflation seems a ways off. Now, I think one of the most misunderstood parts of the inflation numbers is what is the actual inflation that we're seeing, and that actual inflation really just depends on your lifestyle and how much the expenses of things that you're buying has risen. But when you see reported inflation numbers, they're not all the same because what the Federal Reserve Bank is looking at isn't always what you're looking at. For example, you might have heard the CPI has fallen to 3% and everyone's celebrating because now inflation is almost at 2%. But that's not what the Federal Reserve Bank is looking at. The Federal Reserve Bank looks at something called PCE, also known as core inflation. And core inflation hasn't fallen down to 3%. Core inflation has fallen to 4.8%. The next thing that you want to understand is why inflation might be falling. The gradual weakening in demand and improvement on the supply side of the economy is beginning to more clearly translate to lower inflation. So they say that inflation is falling because we're seeing weakening demand and improving supply. So when the Federal Reserve Bank is working to raise interest rates to cool down inflation, what they're working on is decreasing demand. What does that mean? It means less people wanting to buy things. How? Because when you raise interest rates, it's more expensive. Right? When you have higher interest rates, it's more expensive to go out and buy a car. It's more expensive to shop on your credit card. So when the Federal Reserve Bank is raising interest rates, they're trying to reduce demand. And this is where Wells Fargo is saying that demand is falling. Why is demand falling? Well, partially because of the higher interest rates, partially because of the high inflation, partially because of people running out of their savings, and partially because people are racking up their debts. So we're seeing demand beginning to fall, and the supply is starting to increase. Why is the supply starting to increase? Well, we all remember all the supply shortages that we had during the pandemic. And over the last number of years, companies have been working to produce more products, which has been working to increase that supply. So we're starting to see the increase in the supply side of things, which is starting to see more of the equilibrium. Demand is starting to fall, supply is starting to rise, which is causing an easing in inflation. This is where Wells Fargo predicts that by the fourth quarter of 2023, they expect both headline and core PCE inflation to be running closer to the 3% than the 2% numbers when measured on an annualized basis. So the Federal Reserve Bank is trying to bring inflation down to 2%, and Wells Fargo is saying that they're predicting that by the end of 2023, inflation will not be at 2%, but probably closer to the 3% number, which means more work ahead to really bring inflation down. And remember, when inflation falls, that doesn't mean that the prices of things are falling. That means that the prices of things are rising, just not as fast. The fourth point that Wells Fargo talks about kind of briefly is fiscal policy. What is the government doing with their money? Because a big reason of why we are here today economically, financially, is because of the government spending that we saw in 2020 and 2021 into 2022. Even today, we still have some of the COVID precautions and programs out there with the student loans programs being paused. But what is the government going to do? And the main factor that Wells Fargo really talked about here was the debt ceiling. Now, you might remember a little bit earlier in 2023, all the drama that was being created over the debt ceiling almost being reached. Well, that might be happening again. Congress still needs to pass the 12 annual appropriation bills or a continuing resolution by September 30th to avoid a government shutdown. The real reason why this matters is because the government is one of the biggest spenders in the economy because there's really no limit to how much the government can spend. Sure, they have this debt ceiling, but the debt ceiling always has been getting extended. So if the government spends money, maybe they hire police officers, maybe they build a bridge, maybe they hire teachers, money is going into the economy, right? When they create jobs, whether they're paying a police officer, a teacher, or anybody in between, a construction worker, somebody's getting paid. And when somebody gets paid, they have the ability to go out and spend, which helps stimulate the economy. And when the government wants to build new bridges, they're paying contractors, they're paying engineers. That's people getting paid, which helps stimulate the economy. So when the government spends money, people get paid, which stimulates the economy. But there's a cost to the government spending money that they don't have. That's inflation. See, the government is running this large national deficit, meaning they're spending more money than they bring in. And that accumulates into the national debt. We now have about $32 trillion worth of national debt. So when the government keeps spending money that they don't have, there is a consequence to that. I mean, if there wasn't consequences, why do we even have to pay taxes in the first place if the government can just print all their money? The consequence is inflation. So the main topic that Wells Fargo is really talking about is, well, what's going to happen with the debt ceiling? But they also kind of say optimistically that the government can hire some more people if they wanted to keep stimulating the economy. We, Wells Fargo, believe that there's still room to hire more state and local people. And this brings me to the fifth and potentially most interesting part of Wells Fargo's economic report, which is international developments and the United States dollar. Here's what Wells Fargo has to say about our economy. We forecast global growth of 2.7% this year, with risks tilted towards slower growth as China's economy struggles to recapture momentum. Now, most of everything that I cover and talk about has to do with the United States economy because my company, Briefs Media, is in the United States. We cover what's happening in the United States economy. So we don't always cover that much of what's happening in the broader economy. What Wells Fargo is saying is that we're seeing slowdowns in many different parts of the economy and major countries around the world, which could trickle down to the United States because these countries are buying things from the United States. They say that China's economic recovery from COVID is over. The Eurozone slipped into a recession early this year and is likely to experience subdued growth going forward. And in Europe, the UK also continues to be disrupted by higher inflation. Now, while you might be thinking, but these countries are not the United States, why does that impact anything that happens here? They're all the way across the sea. Well, these countries are also major economic players in the global economy. Plus, they're major trading partners with the United States. So if their economies are slowing, that could mean that they're buying less things from the United States, which could hurt the economies here in the United States. But what's interesting also, beyond just the global economies, is what's going on with the United States dollar. Because number one, there's worries about the valuation of the dollar, especially when you have high inflation. Now, I should also say that people have been worried about the health of the dollar ever since the dollar was taken off of the gold standard back in 1971. But especially after the spending that we saw during the 2020 pandemic, people had naturally been worried about the health and the security of the United States dollar. Well, at the same time, we've been seeing a lot of different changes happen with countries and currencies overseas. Like we've been seeing the BRICS nations, Brazil, Russia, India, China, and South Africa come together, working to create their own currency, working to potentially create a currency backed by physical gold. That way they can divest away from the dollar. Now, our dollar here in the United States isn't backed by any precious metals. It's backed by the health of the United States government. It's backed by the promise of the United States military, and it's backed by the strength of the United States economy. But it's really just faith in the dollar that keeps the dollar running. And so if countries overseas start to lose faith in the dollar and they start to divest from the dollar, what does that do? That could hurt confidence in the dollar. And if confidence in the dollar gets hurt, that could hurt the valuation of the dollar. If the valuation of the dollar gets hurt, well, that could really cause more inflation. Now, fortunately, the dollar is the world's reserve currency. That is the best thing that the United States has going for it. But if it were to ever lose its reserve status, that could devastate the valuation of the dollar. And what could cause the United States to lose its reserve status? Well, things to hurt the value of the dollar. And this is where understanding that that is a pretty big thing to happen. It doesn't just happen willy-nilly. But if that were to happen, that wouldn't be good. And so this is where now Wells Fargo is saying, well, number one, we have all these different things happening in the world right now. Right now, there isn't really a replacement for the dollar, but there's a lot of economies that are slowing around the world. These major economies slowing in the Eurozone, in Europe, in China. Well, these economies could hurt the United States economy because that's less money coming into the United States if they don't have money to spend. In addition to that, we also have the risks with the dollar. And especially when you have high inflationary problems, that poses more risks to the dollar, which is something that you want to be aware of. This is where Wells Fargo says that the majority of downside risks in the global economy come from China. So now when you piece all of these things together, we have an economy that is still strong. It's strong because consumers are spending and people have the ability to spend. But this is where Wells Fargo is saying, well, that might not keep staying like this once the excess savings get dried up, once student loans restart, and once people start tapping out on their debts. Once that happens, people might start spending a little bit less. If they start spending less, businesses are going to make less money. If businesses start making less money, well, they might start investing less into the businesses, which could cause a softening in the labor market. Softening in the labor market means higher potential unemployment. Higher unemployment means less people with jobs. And that could also contribute to lower inflation because that's less demand. If people don't have an income, they don't have the ability to spend. If you don't have the ability to spend, well, that's going to be less demand for products at a time where supplies of products are also increasing because companies have been working to increase the supply of their products. And in addition to that, the tighter monetary policy, the higher interest rates, that's going to take some time to really feel the effects of that, while we're also seeing slowdowns in the global economy, in China and Europe. So culminating all these things together, this is why Wells Fargo is saying, yeah, in the short term, things are looking great. But that doesn't mean that everything is going to stay great. And the interesting thing about a recession is that recessions don't happen when people expect them to happen. They happen when people don't expect them to happen, when people don't have the money to capitalize on recessions, because if people have a ton of money sitting on the sideline, you don't have a recession because anytime you see a little drop, people come in and buy. So, what does this mean for you? It does not mean you should blindly trust Wells Fargo. It does not mean you should blindly trust a random guy on YouTube. This means get educated. Be aware, understand the different points of view. Right? We cover what's going on in Market Briefs, my free financial newsletter. I'm going to be covering what's going on in my Investor Summit for free. But this is where it is, number one, important for you to stay up to date on what's happening because we're seeing a lot of changes happen. There's a lot of different opinions about what's going on, but you want to understand what's happening. That way, number two, you can also be prepared. Being prepared means getting financially educated. I cannot say this enough, but 2023 is not the year to go out and finance a new truck. 2023 is the year for you to get financially educated. That way, you can be smart with your money. 2023 is the year for you to get financially smart. Put money aside. Get smart with your money. Build a savings cushion to protect you in case of an emergency. Build a savings cushion to be able to capitalize on asset opportunities in case you see asset prices drop. Then the third thing that you need to do is really work on that financial education. Learn about investing. Watch YouTube videos. Listen to podcasts. Read books. You don't have to go out and start spending a ton of money until you're ready to. Start actually just watching free content. When you figure out something that you want to learn more about, maybe you want to learn more about investing in real estate, then go out and read a book on real estate investing. I don't have any books to sell you. I haven't written a book. I don't have time to write a book, but maybe I will in the future. But right now I don't. But there's a ton of amazing books out there on how you can start investing in real estate, how you can start investing in stocks, how you can build your own company, how you can invest in startups. Figure out what it is that you want to do and then start reading books. And then you can start doing it. And then as you start doing it, if you want more help, you want more education, start taking classes, invest in your own education, invest in learning from people who have already done it, because you can shorten the time span that it takes to learn by paying somebody else to show you what took them years to learn. It's kind of funny. Recently in Briefs Media, we hired a consultant to advise us on how we can improve the efficiency in our newsletter. And some of the things that he proposed to us on our sales side, because we have sponsors in our newsletter, was how we can improve the sales of our newsletter. And there were some little tweaks that really weren't that big of how we can package our ad products, how we can package our sponsorships, which we think can improve our revenues by around 80% by just doing a few tweaks. Now, they're not groundbreaking things, but it probably would have taken us 2 or 3 years to figure out how to do this. But because we just paid somebody, it was kind of expensive, but because we paid somebody, we were able to save ourselves 2 or 3 years. So yeah, paying that money was definitely worth it because now we were able to save years worth of time trying to figure it out ourselves. So once you start doing it, keep investing in your own education because that's how you learn. As soon as you think you know everything, well, you really don't know anything. It's kind of funny. The first time you go out and start reading a book, if you read a book on real estate, you might think you know everything about real estate investing. But once you go out and you read 20 books on it, you realize, oh my God, I really don't know anything. The more you learn, the more you realize you don't know. And that's when you're going to really build that quest and that journey to keep learning. So build that financial education, get financially prepared, and stay up to date on what's happening because there's a lot of opinions out there. There's a lot of emotions out there. The markets are all emotional. That's how they work. But now, because of social media, the internet, and all these online communities, well, people can perpetuate their emotions about what's going on, and it can really entice people to sell or buy based off of what the emotions are at the moment. But your job is not to be an emotional investor. It is to be a financially educated and calm investor because no good investment decision happens out of panic, no good investment decision happens out of fear, and no good investment decision happens out of greed. They happen out of financials and a calm mind. And if you can master that, you're going to have the ability to capitalize on opportunities that will come your way. The days of going to school, getting a decent job, and living a comfortable middle-class life are officially over. And ironically, the more you work for that comfortable middle-class life, the more uncomfortable you'll become. I'll show you. If we go back in time and look at how incomes have changed over the last number of decades, in the mid-1960s, the average CEO was paid